Hi, this is Jeffrey at Graph Financials. So we have the continuation of the what we were talking about. That we are going to use historically low. Sorry about the move. Low multiples for the valuation of Alibaba. All right. So this is for paying subscribers. So this is what we have here. We have those multiples. The first thing to know is that the multiples are very difficult because you need to look into the future. Microsoft performance has really been great, and it was priced at 12 times, so the market had no foresight, obviously. IBM, same thing. Oracle, the market missed because Oracle did not perform as great as the other companies that had at the time a lower multiple. If you think about it, Oracle, if we look at Max, if we look at, it did not perform. It was trading at $30 and it's trading at 116. Oh, this is great. Yeah, okay, we had plenty of monetary expansion. But the Microsoft trading a much lower multiple performed much better. So what I'm trying to say is we could try to do something where we want to be precisely wrong, or we can try to do something where we are approximately correct, and we are going to go for the second. We're not going to, because if you have enough margin of safety, you don't need to be right, absolutely right, and we have a catalyst. They're going to split up. So we might roll over into another situation, special situation, once that happens. All right, so those are the multiples. They were historically low, the price to growth multiple, and that's a good point. Now let's look at the valuation of the China commerce. All right, let's open this. First, we have the segment growth. China commerce was growing 44% between 2020 and 2021, and 22% and 25% between 2021 and 2022. But there was barely any growth between 2022 during the year 2022. So because of COVID. So what I'm going to take, we see, if you look at that, we see that the growth has slowed down. Okay, here. Sorry about that. But it was flat in 2022. We're not going to take 2022, obviously, because the growth is too low. Now, you can expand this, the document in the background separately from the box. You can move the box on the desktop, on mobile too. You can even expand this presenter box on mobile. All right, so this is, let me just take a green pen. This is the income from operation, 172 billion. That's a margin which is 29%, very nice margin. Normally, businesses with very high margin command higher EBIT margin, command higher multiples, irrespective of the growth, because you have ability, you have lots of cash, we can buy back your shares. You have the gap of multiples is required, the cost of capital and return of capital. Businesses that are monopolies, they have this crazy situation where the return on capital is very high and the variability of return is low. If you think about Coca-Cola, for example, this is very high return on capital and variability of profit low. So you have very high return and the market is asking you, is demanding a lower cost of capital. And if you think about, I remember in year 2000, like 20 years ago, everyone was crazy about, flat panels. They had terrible competition, and as a result, it was not a good business to be into. They had lots of growth, but the return on capital was poor. So this is not what you want to look at. You don't look at top line, you look at margin. Based on that, we have 24 billion EBIT in USD, and the EBIT consolidated is much lower. If you look at here, top right, see that? So on consolidation, it's much lower. Okay. Now, multiple of EBIT. We're using 14 times. As a reminder, let me remind that. 14 times EV to EBIT, they have a tax rate which is lower in China, 25%. So that's equivalent on a post-tax and unlevered post-tax multiple. It's equivalent to something around 1867, right? 1867 earnings. All right. That's equivalent to a value of just this segment, not even considering Ant Group, which was the IPO was 250. Just this segment, nothing else. Just this segment would be worth, on an unlevered basis, 360. Let me just put in red. Yeah, do you see this? $336 billion. Okay, versus the market cap today based on the number of shares outstanding and the ADS. There are 8 ADS compared for each Chinese shares. We already are at 76 cents on the dollar. Now, if you look at just the Ant Group at 70 billion and nothing else, not the other segment of Alibaba, we go to 63 cents on the dollar. And we have some net cash. True, there is unconsolidated loss that we have to capitalize. Granted, we have to capitalize probably at the average of valuations. Okay, that's going to be a bit tricky to do that. But just this China Commerce plus Ant Group, the rest cannot be negative, even with the unallocated losses. Okay, unallocated costs. Sorry. We get at between 0.63 and 0.76 cents on the dollar using multiples of a low point of US in January 2011. So the first threshold, are we going to lose money here at that price? And we can say, not really. It's the safe, don't lose money, Warren Buffett stuff. I think we're fine here. We're going to refine to get the more precise number, but the first test is we should have a position here. I mean, that you do what you want. That I'm telling you how I think. Then you do it's your own decision. Thank you very much. Bye-bye.